Hi, welcome to this other session of Kurgateric Finance and Accountancy Tutorials. Today we are going to look at something different. Last time we looked at the final financial statements formats for the sole trader, but there's something that we must look at, some elements that you have to look at before we now become competent in preparation of these financial statements. And these ones are requirements of IAS 1, the International Accounting Standards of that is on preparation of financial statements. So in the books of a sole trader, I told you from our definition of financial accounting that after you've recorded your business transactions, you've classified them and then you've summarized them. I mean, you have opened the ledger accounts and then you've balanced them off and transferred the balances for preparation of these financial statements. But we have some adjustments that must be done at the end of a financial year so that to make sure that the financial statements will portray the true and fair view of the business organization. So today I'm going to take you through the final adjustments of final accounts of the sole trader. So adjustments of final accounts of a sole trader. So ladies and gentlemen, before we continue, why don't you subscribe to this channel if you are not, and you hit the notification bell so that the notification immediately I post the video, you'll be the first one to get the notification. And also you share with your friends, your network. Make sure that they get this information also, because it's free of charge. Let them learn free of charge like you do. And also give it a thumbs up so that I get motivated to work even harder. So ladies and gentlemen, without much ado, let's move straight to the adjustments of final accounts. So we have a number of adjustments that must be done to show the fair view of the organization, that is to portray the true and fair view. So one of the adjustments that we must check is depreciation. Then number 2, we are going to look at the provision of bad and doubtful debts. Then number 3, we also look at the accruals and prepayments. And maybe finally drawings. Ladies and gentlemen, remember when you are given a question, mostly the accounting questions, you'll be given the trial balance, and then after the trial balance you are given the additional information. This additional information is where all these adjustments are normally found. You adjust for this one in the additional information so that to show, or rather to portray that information in the trial balance is correct. In short, the trial balance that was prepared, the trial balance, all the balances there of several items have undergone the double entry rule of accounting, the dual concept of accounting. But the information in the additional information part that you have to adjust, yes, have not gone through the double entry rule of accounting. And it is important for you to adjust them, to make them pass through the double entry of accounting so that to qualify to be part of the information in the trial balance. Are you together? So in short, we are trying to make this information, that is the additional information, to be compliant to the double entry rule of accounting. And some of the things that are normally found, around 99% or 98% in the additional information, are these: the depreciation, the provision for bad and doubtful debts, how to treat them, accounting treatments, and all accruals and prepayments, how to treat them, and the drawings. Very, very, very important. So ladies and gentlemen, today in this session, allow me to take you through the depreciation, and then we look at provisions and accruals in our next sessions as we move on. So let's move to depreciation. Depreciation. So from the layman way of understanding depreciation, depreciation is kind of the loss of value of an item or an asset over its economic time. Let's say you've purchased a motor vehicle at 1 million today. So in 5 years, that motor vehicle will not be 1 million. It must have depreciated with a certain amount of money within that period of its economic life. So the depreciation have got quite a number of methods. The depreciation methods, there are several. So the methods of depreciation, there are several. We have, but the normal ones that are normally examined are: number one, the reducing. Let's start with the straight line method. Straight line method of depreciation. And then number two, we have the reducing balance. Reducing balance or declining method of depreciation. So those are depreciations. And then number three, we have sum of digits method, and so forth and so forth. So, but for the case of the examinations, most examiners normally examine this part, the straight line method and the reducing balance method of depreciation. So let's look at the first one, the straight line method of depreciation, and I will explain this one using an example. Let's say you have purchased a motor vehicle worth Kenya shillings 1 million in 2020. You purchased it in 2020 January. Yes, and then the business or the organization states that the provision of depreciation is 10% straight line. So let me tell you, another name of straight line method is on cost. So make sure you understand this. On cost method of depreciation is the same as straight line method. So most examiners normally indicate that maybe they've provided depreciation at 10% on cost. So that on cost is the same as straight line method. So let's say this motor vehicle was purchased at 1 million in 2020 January, and maybe it has stayed in the business for 2 years. So you have year one, and maybe the provision of depreciation is 10% straight line, 10% straight line or on cost. So it means year one, the motor vehicle depreciated at 10% of 1 million, which is around 100,000. Yes. And then year two, it will be the same 10% of 1 million, which is 100,000. Year three will be the same 10% of 1 million. So it means nothing is changing. It is straight line. Straight line, it's 100,000 depreciation throughout its economic life. Nothing is changing. That's why we are saying the depreciation is on cost, because you are dealing on the cost of that particular non-current asset. We are depreciating on the cost of that particular original cost of that particular non-current asset, irrespective of the number of years that it has stayed in the business. That's why it is straight line. Straight line means no changing, should be fixed. I mean fixed depreciation. I want to believe that is clear. Let's look at another one. The reducing balance method of depreciation. So we're still going to use the same example illustration. The motor vehicle was bought on this, so this is the cost. The cost is 1 million, and then it was purchased in 2020 January. So that means it has stayed in the business for, let's say, 4 years. 4 years, right? So this is how to do. Year one, under reducing balance or declining. From the term reducing, let me show you. Year one will be, let's say it's 10%. It is 10% of 1 million Yes, and then year 2 will be 10% of, not now 1 million, it will be, so this is 100,000, it will be 1 million minus 100,000, which is around 90,000. Are you getting the logic? That is, reducing balance means it is the percentage times the net book value of that non-current asset at that time. Are you together? Net book means what? Net. Anything net means something has been reduced, right? So in this case, the cost, the original cost of 1 million, we reduce the depreciation of that year. Yes? So to arrive at the net book value. So year 3 will be 10% of 1 million minus 100,000 minus 90,000. That way. So in short, the cost of this motor vehicle, the cost of this non-current asset is reducing year by year depending on the amount of depreciation of the year and the previous year. Are we together? So in short, the reducing balance means the depreciation balances reduces year by year. Like here, year 1 is 100,000, year 2 is 90,000, year 3 is around is it 81,000 going down, isn't it? So that is reducing balance. The balance of the cost and the balance, or rather the balance of depreciation, is going down year by year throughout the economic life of the non-current asset. That's why it's known as reducing or declining method of depreciation. So ladies and gentlemen, you will understand this better when we will be taking a question. So those are the two methods of depreciation. And then the general now formula for depreciation is this. Depreciation, this is when you are not, okay, in most cases, these methods you are given the percentage. That maybe the company is providing depreciation on 10% straight line or on cost, 10% or 2% on reducing balance, you see, you'll be given percentage. But there is a situation whereby you are not given percentage. So what do? You use the normal formula of depreciation. The formula is, depreciation is equal to cost, is equivalent to cost of that non-current asset, you less the salvage value, you divide by the economic life, you less the economic life. This is the general formula of depreciation. Is the cost of the non-current asset minus the salvage value. Salvage value means the value that you can sell this non-current asset when it has totally worn out, or when you feel the economic life has reached and then you have to sell it. That is the salvage value. That is the value that you can sell the asset when the economic life is over, and then you divide by the economic life. So let's say the cost of the motor vehicle was 1 million. You less the salvage value, maybe you say the salvage value is around 100,000. And then you divide by economic life. You say this motor vehicle will stay in the business for 10 years. So you divide by 10. So the answer will be the depreciation value, right? Good. So the next thing to do under depreciation is the treatment of depreciation. Treatment, that is the accounting treatment. Accounting treatment for depreciation. This is what you do. In the income statement, you take the full figure of the depreciation of that year. The depreciation of that year is treated as expense in the income statement. So if we find that 10% of the cost of this motor vehicle is 100,000, for instance, Yes, so that is the depreciation of the year. So depreciation of that year that you're talking about will be taken to the income statement as an expense. So under less expenses stroke losses, you also include depreciation of motor vehicle, depreciation of land and buildings. So it depends on the kind of depreciation you are doing. So but in the balance sheet or the statement of financial position, this is what you do. You less from the cost of the asset to arrive at the net book value. That is what you do. So if you find that is what basically what we did, that the cost minus depreciation, you find the net book value. That is what you do in the balance sheet. Yes, so from our format of the statement of financial position, the non-current assets, we said that non-current asset, if it's motor vehicle, you say motor vehicle, the costs minus accumulated depreciation, so that you get the net book value. So what forms part of the accumulated depreciation is the depreciation of that year, and then you add the depreciations of previous year so that you arrive at the net book value, right? So ladies and gentlemen, that is all about the depreciation. Other methods will follow, right? So that is how generally what is adjusted as the final adjustments of the final accounts. You will find that in the additional information. Very, very, very important. So in our next session, we'll look at the provision for bad and doubtful debts, right? So until then, it's goodbye for now. Subscribe.